Jenny Brown. A very, very warm welcome to MFB News. I hope you're all really, really well and you've been able to get out and enjoy some of the sunshine. What an absolute gift to see the sun. It feels like we haven't seen it in forever. I managed to get out in it yesterday. I had a day trip out to London. I'd really recommend it. I went around for a tour around the Houses of Parliament. It was really good. Didn't see Keir Starmer or Rachel Reeves, probably a good thing. When you go into Parliament, incidentally, you can see all the politicians like little pigeonholes, and I was really tempted to leave a little note letting them know some constructive feedback, but I think the security guards may have just stopped me, so I decided not to. Now, in terms of what we're going to be covering off for you this week, we're going to do our usual. We're going to look at swap rates, we're going to look at lender pricing changes, and actually go into some detail around a couple of the changes and what this could actually mean in terms of for you as a borrower, kind of get you thinking about things a little bit. Then we're going to take a bit of a deep dive into the Future of Renting survey, a really interesting survey that's been carried out across landlords, tenants and letting agents. Some of the responses make some interesting reading, so I really wanted to share that with you this week. And then finally, we have got a question of the week, which I'm going to be answering. It was sent in a couple of weeks ago. It's taken me forever to get an answer. This is all relating to how valuers are going to be assessing renters' rental income post Renters' Rights Bill coming into play. So finally got a response from a surveyor that I can share with you, so we'll be coming on to that as well. Now, before we dive into today's content, I just want to kind of introduce MFB News to those of you who are maybe watching this for the first time or have only seen a couple of episodes, because I think it's really important that we kind of set out the purpose of MFB News and what it's for, and then invite your kind of feedback. So MFB News is really here to keep you fully updated in terms of changes in the mortgage market, talk to you about the premise of mortgage lending in different kind of categories. So for example, HMO lending, refurb finance, all that kind of sort of more complex stuff, so that you as a property investor feel empowered to be able to make really good decisions. So really, the whole aim of this is to be educational, essentially. We do extend into the broader market, so we talk about things in the private rental sector or things that impact the private rental sector. So for example, inflation news, economic data, we'll look at the private rental sector as a whole, legislation, all these kinds of things, with the hope that we're bringing you as much up-to-date information that you as a property investor really, really needs. The reason I'm raising this point now is that actually we're very open to tailoring the content of this. This is purely for the benefit of those people that watch the video. So if there is anything that as a viewer you would like us to include, any questions that you want to ask, you're very, very welcome to do so. This is by no means a set format. And for those of you who watch this regularly, you know that we are quite fluid in terms of the kinds of content that we cover. So for those of you who are watching this for the first time, welcome. This is your kind of orientation about what this video is actually for. And for those of you who are more frequent watchers, this is a strong invitation to give us any feedback so we can ensure we're delivering something that is really, really relevant and informative to you every single week. Swap rates. So when I started planning this video yesterday, I was thinking, oh goody, not much has been going on really. It's been quite a quiet week. And then I got up this morning and got ready to record, and a ping came through on my phone from the BBC saying that inflation has jumped up to 3%, which is a fair bit higher than people were expecting. Is this something to really worry about in terms of inflation? I mean, it's not going to be good news, is it? But actually a kind of hump in inflation has been predicted. It's just the level of increase in inflation that was kind of not expected. So what's going to be really interesting with this is what the inflation figures bring over the next few months, and whether this is kind of a outlier or whether actually this is kind of a trend, and that's going to really impact how the money markets respond. So in terms of swap rates, so looking at the data available, this is from 11:45 last night on Tuesday evening. 2-year swap rates were at just under 4%. 1 month ago, they were at about 4.17%, 4.18%. So we're month on month, we're in a better position. 1 year ago, 2-year swaps were at 4.5%. So actually year on year, we're circa 0.5% lower. So that's really, really encouraging. 5-year swaps, for those of you who watched last week, you'll remember that 5-year swaps were sitting at around 3.7. They're now at 3.9%, so an increase of around 0.2%, so not an insignificant step up there. 5 swaps 1 month ago, 4.04, so marginally lower month on month. Year on year, swap rates were at 3.96 on 5-year money, so actually almost year for year we're in the same position. So what can we read into this? So I think actually the capital markets, the fact we've seen swaps go up a little bit, would kind of imply to me that they're expecting this inflation news. Obviously the inflation news. So what we've seen is the Bank of England has been in real growth mode by cutting interest rates and looking to really kind of sort of get people spending money and boosting the economy. However, we've also seen really strong wage growth and this kind of stuff. So essentially there's going to be a real conundrum now for the Bank of England in terms of if we keep cutting interest rates, which is inflationary, what's that going to do to inflation? It's a very fine balance for them. So what I suspect we're going to see, and they're going to be watching the inflation data going forwards. The next MPC meeting is in March, but actually I think they're going to just want to see that data come through for the next round of information before making any hasty decisions. But I suspect this information is going to really slow down the pace at which base rate starts to reduce. Okay, now in terms of lender pricing, so the swap rates have kind of just floated up in the last couple of days. So what we're not going to have seen is lots of lenders adding 0.2% onto their interest rate straight away. While things are very kind of connected, they're not that connected. It does take time. And also lenders tend to, in times of interest rate volatility, lenders will always build in a bit of a buffer to their mortgage pricing so they can kind of absorb a small fluctuation in their cost of funds. So whether we're going to see a rush of lenders now pulling rates and putting them up will remain to be seen. But in the last week, because lenders have been reacting to swap rates coming down, what we did see is a little wave of lenders reduce their pricing. Not huge, but still some changes downwards, which we love nonetheless. So first of all, we've seen the Coventry reduce rates by up to 0.1%. Coventry, just to touch on them because we haven't talked about them for a while because they've been relatively quiet. Wonderful lender, very vanilla, straightforward properties in personal names. Landlords can have up to 10 buy-to-let properties in their portfolio. One thing that the Coventry do, which is really nice that not all of the kind of high street lenders do, is their cap of 10 properties only applies to those properties in your personal name. They ignore anything in a limited company. Whereas most lenders are going to say, we want to know all about all of your properties personally and all of your properties in a limited company. And if that's over 10, we wouldn't lend to you. So actually what the Coventry can do is give access to high street pricing for those borrowers with some properties in their own name, but actually the lion's share of their portfolio held in a company. But like I say, really good lender. Their service is absolutely second to none and we really, really rate them. So lovely to see them bringing down their pricing by a small amount. We've seen the Kensington release some new rates. They now have 2-year fixed rates from 3.89 and 5 years from 4.79. Kensington are a specialist lender, so with that kind of rate you would expect to pay a higher fee, and they have, as most lenders do these days, have a broad range of rates, so very low rates with a higher fee, working their way up to the highest rate with no fee at all. Kensington is a lender, a very interesting one, so a lot of you would kind of be familiar with them, particularly pre-credit crisis. It's going to show my age here. They were kind of regarded as what was in those days known as subprime lender, so people essentially lending to people with slightly more complex credit profiles. Very, very different lender these days. They were bought by Barclays and they are now doing very sort of more vanilla lending. So they're not an adverse lender by any stretch of the imagination. What they are is a specialist lender who has funding from a large UK bank and therefore they can access some fairly cheap money. So what we're seeing Kensington doing incredibly well in at the moment is the limited company space. Their pricing there is coming up tops a lot at the moment. They have some relatively good rates with flat arrangement fees. So rather than these percentage charge fees, they can offer rates with flat arrangement fees, and these tend to work out very well for people. So great to see Kensington evolving their pricing set. TMW have reduced their limited company rates by 0.2%. As always, when a lender like TMW, who is the UK's largest buy-to-let lender, drops rates down, people take notice. So it's good to see them bringing things down a little bit. They tend to be very competitive. In the last few weeks, actually, there's been a lot of lenders pricing underneath them. So I suspect this is really just them, realising that actually they're a little bit out of kilter with the market and dropping their rates down a bit. And they've also introduced what they're calling pre-application checks. And what they're saying is that actually now, when a broker submits a mortgage application to them, they're going to run a check on the company straight away to make sure that it fits their criteria. Now, this is an interesting one and actually just worth going into a bit, because limited company structures and what lenders accept is actually quite complicated if your company structure is not dead straightforward. And I'll come into what that actually looks like in a second. But often we will get mortgage applications in. Sometimes the borrower doesn't actually understand the structure of their company. That's quite common because accountants can do some really whizzy things to make you uber tax efficient, but actually then it can kind of limit the number of mortgage lenders that would lend to your company. So when we're looking at company structures, there are the lenders who kind of want the most basic structure, and the Mortgage Works would fall into this. So what they're essentially saying is that there needs to be a limited company which is set up for the sole purpose of renting property, and that company has to be owned entirely by its shareholders, and they're going to take personal guarantees from all of the directors and all of the shareholders. And at the moment, I think they might have changed now actually, the Mortgage Works were only able to accept 2 applicants. So literally, to kind of be really stereotypical, it could only be a husband and wife team who own a limited company, directors of the company. They're the only that's the only kind of structure they could consider. So that would be like the most basic kind of structure. The other thing to be aware of is that when looking at the activities of business, like what classifies it to be an SPV, a special purpose vehicle. And this is one that people sometimes come a cropper on as well. So a special purpose vehicle is a company which has been set up with the sole purpose of letting out property, and the only income streams that the company demonstrates is rental income. So it might be that actually we have a client who has a property rental business, but they also do a little bit of refurbishment and selling. So when we look at the company accounts, we would know that because of this portfolio that the client has, the rental income is say £50,000 a year. We can look at the accounts, we can see the turnover. If that figure is not £50,000 or less, because you might have had rental voids and that kind of thing, then the lender's going to immediately say, well, hang on a minute, you've got additional income above what we would expect the property to be receiving as rents. What's going on here? So lenders do start digging into these things, even if you do have the right SIC code. So SIC code, Standard Industry Classification Code, is basically a code which tells Companies House the activities of your business. So for property rentals, it's 68100, 68209, they're the kind of key ones. And there are a couple of others that are accepted as well. But even if you've got the right SIC code, the lender's still going to look at your accounts, look at the turnover, and be able to assess very, very rapidly whether there are additional activities. So if you have lenders like the Mortgage Works, they're going to immediately kick the case out, because if there is other income coming in, the property is not a really true SPV. Okay, so back to company structures. So this is where it can become slightly more complicated. So we come across all different types of structures at MFB. It's not a problem, but actually it's just being aware of these structures from the outset. So you might, for example, have a company where you have company directors who are also shareholders, but the shareholders might be, for example, let's use our traditional example here, husband and wife, but also their 2 children who are minors. It could be that we have a company structure where it is husband and wife are directors, but the shareholders are the children only. So the shareholders are not the directors of the company, so 2 totally separate things. It could be that we have a structure which is the directors are husband and wife, but the shareholders are one of their limited companies. So say, for example, they're an IT consultancy as a kind of day job. The IT consultancy owns the shares of their company. So there's many, many types of structure. I could go on for ages listing all of it. It would get really boring, wouldn't it? But the point is that actually a lot of company structures are not straightforward, because they've been set up specifically in a way that is to be most efficient for tax. If you have one of these structures, that's absolutely fine. There are lenders who will lend to you, but people like the Mortgage Works wouldn't, which is why it's really important to make sure that the company structure is bottomed out at the very start of an application, because otherwise things can go wrong. So kind of looping right back to the beginning, it's great that the Mortgage Works are making these checks up front. Your mortgage broker should also be doing this for you. The information that's available on Companies House, it's very, very easy to access. It takes a few moments, so it's really worth having a look. Now, just while we're on the subject, I just want to cover off one other thing actually, because this can be a thing which people stumble on. So I have come across situations where a client has an SPV, the company's only activity is rental income, but that SPV company also owns the shares of another company. And this tends to be, generally speaking, if the company owns the shares of a company that's been set up just to own the freehold of a property. That's where this is most common. Now, some lenders will kind of look at that and say, you know what, it does own shares of another business, but actually that business is also property related, so we can get comfortable with this. There are other lenders who say no, because actually a true SPV only holds and rents out private rental property. And therefore, by virtue of the fact it owns shares in another business, that stops it being an SPV. So it's just worth being aware of if that were to apply to you. So there you go. So the Mortgage Works, bit of a change in lending criteria. looking at companies up front, which will avoid kind of aborted applications down the line. That invariably saves our clients time and money, which is absolutely brilliant. So well done at the Mortgage Works. Lastly, on the rate changes, foundation home loans, they've dropped some rates by 0.3%, and YBS have dropped their commercial investment and semi-commercial investment rates by 0.15% and commercial owner occupier by 0.2%. We are going to be digging more into the commercial space as the weeks go on, because quite simply put, more and more investors are starting to turn their attentions to particularly semi-commercial but also full commercial properties as a kind of diversification to their portfolio. Why are they doing this? Because often the yields are much better on these types of properties, but also there is a saving to be made on the stamp duty as well. Now finally, I wanted to just talk about tracker rates, because Fleet Mortgages have bought out some tracker rates which are available to standard properties, limited companies, HMOs and multi-units, so very, very good. Trackers are definitely a conversation which is coming back onto the table, which they hadn't done for a while. And the reason being is that actually when you're looking at fixed rates and you're thinking, well, I could take a 5-year fixed rate and this is what my payment is going to be, and I know that it's great because I'm going to have security of payments for the duration, which is lovely. But actually I also know that the prediction is, and the predictions still stand, that base rate is going to come down, particularly throughout the rest of this year, by around 0.5%. Actually, there is a school of thought whereby trackers could be something worth considering. So what is stopping people taking trackers? So first of all, it's the worry that actually interest rates might go the other way, so there's no stability of payments. So it's great to capitalise on interest rates coming down, but what if they were to start to increase again? So that's the first thing, so it's the uncertainty. Secondly, the rental calculations. Lenders will stress test tracker rates in the same way that they stress test 2- and 3-year fixed rates. So it's a more onerous rental calculation. That might mean that you simply cannot access a tracker rate. But the third thing is that actually, particularly in the specialist space, the tracker rates are actually starting at a fairly high level. So it would take quite a few base rate reductions to happen before you actually were better off on a monthly payment basis taking the tracker in the first place. So that's a barrier for people as well. So just looking at tracker rates and what's available at the moment, I mean, there are actually rates available from 5.23%. This is more on the vanilla end of the market. One of the ones that we're doing a huge amount of traction on at the moment is with the Skipton Building Society, where there is no early repayment charges. People really like this. So these are rates from kind of like around 5.24%. So you can get a tracker rate, you can benefit from base rate coming down. There's no early repayment charges, so once the base rate reductions start to really bottom out, people can then kind of rethink things and maybe remortgage onto a fixed rate at that point and lock in on the new lower interest rate. So just a bit of food for thought really. Trackers haven't been terribly popular in years gone by, but actually we're certainly seeing an uptick in the number of borrowers who are seriously considering them. Okay, now I've gone on a bit with the old lender updates there, so I'm going to try and keep the future of renting survey debrief for you guys slightly shorter than I was going to. Otherwise we'll be here all day, won't we? So the future of renting survey is essentially that goes out to landlords, tenants and letting agents as well, and people are asked various questions in terms of their intentions and feelings about the sector, and they respond, and then a survey is compiled, like a normal survey really. The future renting survey was completed. 48% of respondents were landlords, 47.5% were tenants, and the remainder were letting agents. 47.4% of respondents were female, 46.8% were male. I guess the others simply just said that they didn't answer whether they were one or the other. Now, there is a huge report on here. We can send you links to it. It does make really interesting reading, but here are some really key takeaways. So first of all, continued turbulence in the private rented sector. So the sector remains under pressure from regulatory, economic and market forces, with the Renters' Rights Bill set to bring significant changes in 2025. Over half, so 53.7% of all respondents believe the sector is not fit for purpose. This compares to 2 years ago when 3/4 of landlords and agents felt that the sector was fit for purpose, which is reflecting a growing lack of confidence. So confidence across everybody who's kind of a key part of the PRS is the feeling that it's actually less wonderful than it was even so much as 2 years ago. Tenant challenges now, these centre around affordability and security. So rising rents, 88.2% of respondents, and a shortage of properties, 49% of respondents, and a lack of long-term security, 43.6% of respondents dominate tenant concerns. Despite challenges, 64% of tenants feel secure in their homes and 73.7% report satisfaction with the quality of their property that they're living in. We can kind of look at this, think back to the end of section 21, no fault evictions, and also the decent home standard. And actually, when you hear those statistics, it does make you think, well, how bad are things? Do we really need legislation to protect against this? Landlord and agent sentiment has declined amid regulatory pressures. So over 2/3 of landlords, 67.2%, and more than half of agents, 52%, believe the sector has deteriorated largely due to legislative changes and economic challenges. While regulatory compliance means the top challenges for landlords are 34.3% of you, many are adjusting to anticipated changes, with over half intending to stay in the sector long term. We always say this, landlords are like the most resilient bunch of people we've ever come across. And over the last sort of 10 years, there has been so much change thrown at you guys. We are always in absolute awe of the way that landlords simply pick themselves up, adapt and get on with the thing that's important, which is renting out their properties. And it sounds like from this report, that really just echoes that. Sector-wide concerns around rising costs and supply shortages. So rising costs, energy efficiency requirements and limited rental stock are common challenges for landlords and agents. Over 58% of landlords and agents now question whether renting offers good value for money, a sharp decline from 2023 levels where 85.8% of landlords and 73.2% of agents felt that renting offered good value for money for their tenants. So essentially, both landlords and letting agents are saying, crikey, actually at the moment renting is really, really expensive. Is it representing good value for our tenants? Energy efficiency gains. So nearly 80% of tenants consider energy efficiency important, and over 58% of landlords have already made eco-friendly upgrades, while nearly 29% plan to upgrade properties to meet EPC level C standards in the next 5 years. You guys are going to have to get a wiggle on. You've now got 3 years, by the way. Tenant demand and regulatory pressures are driving energy efficiency upgrades. So that's nothing to kind of be surprised about. Okay, Renters' Rights Bill. Mixed reactions to the Renters' Rights Bill provisions. The abolition of Section 21 remains overwhelmingly the top concern for 60.61% of landlords and 68.5% of agents, with both being least worried about the end to rental bidding wars. So that's the thing that you guys seem to be least concerned about. However, awareness of the bill among tenants is low. Just 26.9% of tenants are aware of the bill, indicating a need for better communication about forthcoming changes. Pets in rental properties and other emerging trends. Landlords are becoming more open to allowing pets, with only 16.2% refusing under any circumstances. And that's a notable shift from 2023, where 49.6% of landlords were against pets in rental properties. Is it a notable shift in people welcoming it, or is it just an acceptance that that's the way the world's going? Who knows? Traditional deposits remain the deposit solution of choice, with only 2.4% of tenants opting for a deposit alternative and 15.6% of landlords and agents reporting that they have ever used a deposit replacement option. Positive tenant and landlord relationships persist despite challenges. So the majority of landlords, the 65.2% of you, are responsive to tenants' needs, and nearly all landlords and agents, 98%, rate their relationship with tenants as satisfactory or better. Moving on to government support. So most landlords, 76.2% of you, and agents, 73.5% of you, feel less supported by the current government, surprisingly. A decline since 2023, when 61.9% of landlords and 50.2% of agents felt not supported by the government. So actually things have really deteriorated in terms of how we view essentially our relationship with our government. Even tenants, the primary focus of new regulations, report low levels of increased support from the government, 17%. So actually what's going on here, it looks like, from the government is not landing well across any parts of the PRS. I can't say that surprises me. Lastly, future prospects. depend on navigating change. So legislative compliance, can't say that word this morning, supply challenges and rising costs will define the sector's future. Proactive preparation for regulatory changes and fostering collaborative tenant-landlord-agent relationships will be crucial for stability. Hallelujah to that. I think we all know that, and I think we all try and work on that basis. But thank you to the report for reminding us of that very good bit of advice. Moving on to a question that we've been asked by one of our wonderful watchers. Thank you very much for sending this in. Do send in questions, guys. I love this. What is the view from lenders when landlords are looking to remortgage in light of the potential FTT rental reviews, and how will valuers assess the rent? This might be crucial for those landlords with higher loan to value ratios. What an amazing question. So essentially what we're asking here is, with the changes that are coming in with the Renters' Rights Bill, and particularly the tenant's ability to challenge rents, how is this going to impact how valuers assess them? So we spoke to a valuer. I'm not going to say which lender because they're quite keen for anonymity, but essentially they've put together a really comprehensive response. I will, to the viewer who sent in the question, get this passed to you by your broker Chris, so you can see the whole thing. But for the purpose of this video, what they're essentially saying is that in terms of rents that the valuer reports for mortgage purposes, this is the market rent, and that's the RICS definition for the property as at the date of the valuation, as supported by comparable market evidence. The valuer has regard to rents passing where known, but these may be above or below or consistent with the market rental value. The valuer will therefore continue to undertake the professional assessment as per their existing process. There will be no change to this. So essentially what he's saying is it's going to be very much business as usual going forwards. Sorry, a bit of a longer episode than normal, but hopefully time well spent watching it with lots of interesting information there. I'm going to wrap up real quick because I don't want to take any more of your time. So thank you very much for watching, and you know where we are if you have any questions. 0345 345 6788. I will see you same time next week.